War breaks out. Within hours, gas prices jump 50 cents, then $1, then more. Oil shoots past $100 a barrel. Headlines scream about supply disruptions, energy crisis, global instability. You pay more at the pump. You pay more to heat your home. You pay more for everything that moves by truck, ship, or plane. You've been told this is supply and demand. War disrupts oil supply. Less oil means higher prices. Basic economics. But here's what doesn't add up. In most wars, actual oil supply disruption is minimal. Tankers keep moving. Wells keep pumping. The world isn't actually running out of oil. So why do prices spike so dramatically? And who profits? Oil companies, posting record profits every time there's a conflict. Commodity traders, making billions betting on price movements they help create. Speculators, buying oil futures not to use oil, but to profit from fear. Oil prices don't spike during war because of supply shortages. They spike because war is the perfect cover for extraction, and everyone along the chain takes their cut of your fear. Today, we're exposing the hidden economics of wartime oil prices. Not why oil matters, but who profits when bombs start falling. Let's start with how oil is actually priced. Oil prices aren't set by how much oil exists today. They're set by futures markets, bets on what oil will cost months from now. Traders buy and sell contracts for oil that won't be delivered for months. Most never take delivery. They're just betting on price movements. When war breaks out, traders don't wait to see if supply is actually disrupted. They immediately bid up prices based on what might happen. Fear gets priced in instantly. It's called the risk premium or the fear premium. Analysts estimate war can add $10 to $30 per barrel just in fear premium before any actual supply is affected. When Iraq invaded Kuwait in 1990, oil prices doubled in 3 months. But global supply only dropped about 4%. Prices rose far more than supply justified. When Russia invaded Ukraine in 2022, oil hit $130 per barrel. But Russia kept selling oil, just to different buyers. Global supply barely changed. Traders and speculators profit from that fear premium. They buy before prices spike, sell at the peak, and pocket the difference. Your fear becomes their paycheck. Now look at oil companies. In 2022, during the Russia-Ukraine war, the top 5 oil companies made over $200 billion in combined profits. Record-breaking. ExxonMobil alone made $56 billion, its highest profit ever. Chevron, Shell, BP, all posted record or near-record profits. Go back to the Gulf War. Same pattern. Every major conflict involving oil-producing regions, same result. So how do oil companies profit from war? Most major oil companies own their reserves. They pull oil from the ground at the same cost whether there's war or peace. But they sell at the market price, which just spiked. Their costs stay flat. Their selling price soars. The difference is pure profit. It's called a windfall profit, money that falls into your lap because of external events, not because you did anything better. They don't drill new wells. They don't hire more workers. They don't innovate. They just collect more money for the same oil. And what do they do with those profits? Stock buybacks, dividends, executive bonuses, not lowering your prices, not investing in alternatives, not preparing for the next crisis. Their costs don't change. Yours do, and they pocket the difference. Now here's something most people miss. Crude oil is not gasoline. It has to be refined, and refiners have their own game. The difference between crude oil prices and gasoline prices is called the crack spread, the refiner's margin. Normally, it's $10 to $15 per barrel. During crises, it can explode to $30, $40, $50 or more. Refiners say it's capacity constraints. But refining capacity doesn't change overnight. The war didn't suddenly destroy refineries. They charge more because they can. You need gasoline. You can't wait. They have pricing power. In fact, companies have been closing refineries for years, reducing competition and boosting margins. They benefit from scarcity they help create. Now let's talk about the players you've probably never heard of. Vitol, Trafigura, Glencore, Gunvor, Mercuria. These trading houses move more oil than most countries produce. They buy from producers, sell to refiners, store oil, arbitrage between markets. They have information you don't. They know where every tanker is, what's being loaded, where it's going. They know before markets do, when supply is actually disrupted. And they trade on that information legally. When war breaks out, they're already positioned. In 2022, Trafigura made $7 billion, its best year ever. Others posted record profits too. They don't just profit from high prices. They profit from volatility itself. The bigger the price swings, the more money they make. War creates maximum volatility. It's their ideal market. Commodity traders profit from chaos. And it's not just them. Hedge funds, investment banks, even pension funds are in the oil market. Oil futures have become a financial product. Estimates suggest 70 to 80% of trading is speculative, people who never intend to take delivery. When war breaks out, money floods into oil. Safe haven. Hedge against instability. War means higher prices. That buying pushes prices higher. More buyers lead to higher prices, which attracts more buyers. A self-fulfilling loop. Meanwhile, banks profit from trading and fees at every step. Now let's talk about governments. When oil prices spike, oil-producing countries benefit, even if they're not involved in the conflict. Revenues surge. Budgets go into surplus. Governments also collect more through taxes and royalties. Higher prices mean higher tax revenue. And when prices fall later, they don't refund you. They keep the windfall. They can also release strategic reserves to temporarily lower prices, then buy back cheaper later. Publicly, they worry about your pain. Quietly, they benefit from it. And here's the final piece. Prices rocket up when war starts, but fall slowly when it ends. It's called sticky prices. Gas stations are slow to lower prices. Refiners maintain high margins. Traders keep prices elevated expecting the next disruption. Each crisis pushes prices higher. They never fully return to where they started. What was once a crisis price becomes the new normal, until the next crisis pushes it even higher. Now step back and look at the system. Traders price in fear instantly. Oil companies sell at higher prices with the same costs. Refiners expand their margins. Trading houses profit from volatility. Wall Street fuels speculation. Governments take their share. Everyone profits. Except you. You just pay more. So the real question isn't why oil prices spike during war. The real question is, who profits when they do? Oil companies, traders, speculators, financial institutions, governments. The same players. Every time, oil prices don't spike because supply disappears. They spike because war creates the perfect cover, and everyone takes their cut before you can ask questions. Once you see the system, you start to understand why every conflict leads to record oil profits, and why the people benefiting have no real incentive for lower prices or lasting peace. The winners don't change. Only the crisis does. If you want to understand more hidden economics, who really profits from the systems around you, subscribe and follow. And if you want to go deeper, check out why your electricity bill keeps rising or why gas prices never fall as fast as they rise. Next time, who profits from defense spending and why wars never seem to end. I'll see you there.